Hey everyone, Matt and Anthony from the PD Group Wealth Management, and this is the Finance Things in Life. Today, we're going to be doing the financial inbox.
Yeah, we have asked in previous podcasts what financial questions that you have for us that you'd like us to answer. Some of you have reached out through the comments, Instagram, Facebook, direct message, and we've taken a few of those and brought them here today and figured we'd go over them at random.
Yeah, perfect.
Should be fun.
Yeah, should be fun and interesting.
Yeah, very interesting. Yeah.
I think, I'm hoping that we get the one about fantasy football and, who we should draft first, but we'll see.
I like that. Dynasty draft or redraft?
Dynasty.
Dynasty draft. Ashton Genty. Ooh. This one's a good one. What are your thoughts on cryptocurrency?
Oh, man.
The gift that keeps on giving. I feel like I probably talk to, almost every single meeting I have with a client or prospect, we bring up cryptocurrency.
Yeah. I mean, it's a hot topic, especially with this administration, seeming to be in favor of cryptocurrency.
Dogecoin?
Dogecoin. But, it's a topic that, I don't know how much we can get into detail, but, because I don't know a ton about cryptocurrency, but, it is an asset that people are interested in, that people are investing in. There is a ton of risk, though, with cryptocurrency, regardless of, whatever coin you're buying, whether it's Bitcoin, Ethereum, or Dogecoin, or, whatever one you want to talk about. But
it's one of those assets that's extremely volatile off of very little information. It's not like it's going off of earnings or future projections. It's more of if someone famous says they really like crypto or a new coin is getting launched, it seems to affect the either Bitcoin or Ethereum dramatically, and it's really hard to predict. Obviously, if you started really early, I don't even know when it came out. I think I started hearing about it back in like 2016, 2015.
Yeah, it was before that, but yeah. It's there's a ton of risk. So it's not an investment that you're necessarily going to put in money that you're counting on. I think if you are investing in cryptocurrency, it's money that you're okay with,
Potentially
going to
losing.
zero, right?
Yeah.
Losing it all.
Yeah.
So I think that's the big thing is you have to be okay with having an abundance of risk if you're investing in cryptocurrency.
Yeah. I had a friend not too long ago ask if he should cash out his entire IRA and put it into crypto, specifically Bitcoin. And, everything's a personal preference, but at that point, that seems like a little bit too much risk for me to cash out an entire IRA. One, pay the taxes on it, pay the penalty on it because you're cashing out early, and then put it into a volatile asset that you don't know if that's going to pay out or not. That's way too much risk for me, especially with a retirement savings vehicle like that.
Yeah. Now, I will say there are investments that you can buy. So you don't have to necessarily buy Bitcoin or Ethereum or any cryptocurrency directly. They do have ETFs that you can use or purchase and have, your hand in cryptocurrency, whether it's Bitcoin or Ethereum. So you can invest in it that way. It still trades like the actual cryptocurrency, but you have the investment. You can have it in your IRA or brokerage account. So that is a way to invest in cryptocurrency without investing in the actual coin. The other thing is they are now offering buffered ETFs for cryptocurrency. So these ETFs where you have this downside protection within the coin. So, if it is something that you are interested in purchasing, I mean, that might be a way to kind of
Dip your toe in.
Dip your
Oh,
toe-
wow. Did we just say it at the same time?
We did.
That's impressive.
Dip your toe in and take a little more or a little less risk than actually buying the coin outright. So that would be an idea. But I mean, like I said, a lot of risk in cryptocurrency. I'm not saying that there's not a place for it, but there is a lot of, regulatory risks, security storage risks, and just the volatility might not be for everyone.
Yeah. Yeah. And there's risk with every investment. I mean, any investment could potentially go down to zero theoretically. Yeah. But just with crypto, there's just so much unknown around it as far as how it'll be used, what the future of it is. It's just one of those things it's difficult to really look at as a viable option that I just can't wrap my head around as far as that goes.
Yeah. All right. Next one.
Next one. Do you want to pull it or you want me to pull it?
I can pull.
All right. All right. We'll go back and forth.
We can go back and forth. All right. Retirement planning. What should I start doing now?
Oh, man. What should I start doing now? I wish I had an age on there. Hopefully whoever submitted this is younger. So if you're starting off in your career, retirement planning, I would come up with an ideal scenario. Obviously, like we've talked about in other episodes, your retirement plan is ever changing. You could be 3 years away from retirement and it could completely change depending on your circumstances. I would first start off if you're working and your employer offers a retirement plan, I would start investing into that, especially if they offer a match. That would be one of the first things.
Yeah. I mean, starting early is key. I mean, I think we've said that before. Probably the most important thing is to start as early as possible. Doing some sort of financial plan, retirement plan, is also important. That way you kind of, what your goals are and if what you're doing is going to get you to where you want to be. But for retirement planning, the younger you are, the better. Now, if you're older and, maybe you have 10, 15 years to retirement, maybe even less, that's extremely important where you need that retirement plan. You need that financial plan because you have a lot, less time to get it right. Mm-hmm. And at that point, you need to get it right in order to meet those goals. Because the longer you wait, the less time chance you have of making sure you're investing enough, saving enough. So
yeah, and make sure you're using all of the tools to you're utilizing all the tools available to you. So like catch-up contributions, the super catch-up contributions that we've talked about, making sure you're putting away as much as possible to reach those goals. That would be very beneficial. And it's difficult if you don't have those goals in place, if you don't know kind of what your target is, it's difficult to say how much you should be contributing and how you should be investing. If your goals are a bit more lofty and you have some time, then you're going to obviously want to start investing a little more aggressively. If you're coming up on that retirement age and you're trying to build up your balance, maybe you're a little bit more conservative.
Yeah. And I think, getting back to what you said earlier is your plan's going to change, especially if you're a younger investor. Let's say you're just starting out, you're single, once you get married, you might change your plans if you start having kids.
Plan changes again.
There's a number of things that can come up. So starting early, making sure you have that plan in place. And then once those, life changes happen, updating your plan just to make sure everything is up to date for you. So
Yep. Yeah, make sure you're speaking with your advisor on those life changes so they can properly advise you on what changes you should be making to your plan, considerations that maybe you haven't thought of.
Yeah, making sure your allocation's right because, you spend, you could be putting money away for the first 10 years. And if you're sitting in cash, I mean, that's probably not going to be the results you're hoping for.
Yep.
So
Yeah.
making sure your allocation's correct is super important as well.
Yep. Awesome. Good question.
All right, your turn. What do we got?
And drum roll, please. My parents are aging. What should I start doing to prepare to help them?
All
That
right.
is a good one.
That is a good one. We know how that is.
Our dad's birthday.
Yeah, our dad just celebrated his 60th birthday. So
shots fired.
Yeah. No, he's 60 years young. But no, it's I mean, that's a good question for people that might have parents getting into their 70s, 80s. A lot of times adults or parents will usually help guide their kids with their finances at first. Maybe when they're starting their first job, the parents are kind of giving that guidance. But what often ends up happening is the parents age, the kids start handling the finances. And so having those conversations with your aging parents, or if you're an older investor and maybe in your 70s and 80s and have kids, it might be a good idea to start getting them involved, making sure they know who your advisor is, maybe bringing them into meetings.
Mm-hmm.
And so there's a connection there, so they know what's going on with your finances, in case something the inevitable happens. But
yeah, and just piggybacking off of the going to the meetings, if the cognitive ability of your parents starts to decrease, then you're going to have to step in even more. So if their decision making is not up to par, then maybe you're going to have to step in and start making some of those financial decisions for them. So making sure you're having that conversation with your parents, making sure you're staying involved, being aware of what their wishes are, what they want to do with the money they have, any charitable contributions they want to make, what their will is, what their estate plan is as far as, what kind of legacy they want to leave. If you're going to be inheriting money, we've talked about this before. You want to be aware of that before you sit down with their attorney to go over what you're inheriting. You want to have some planning prior to then. That's a huge advantage to have.
Yeah, and your parents, hopefully they have their will up to date. If they have any trusts established, their estate plans. But that's the time where maybe you start talking about gifting strategies depending on their financial situation, where they start maybe gifting the children or grandchildren, or should the house be in a trust or any other accounts, protecting those assets. The earlier you start with that, the better, but that would be something to kind of keep in mind for aging parents, as well as making sure their financial situations up to date, in line with what their goals are.
Yeah, and I would want to understand the history of your family health wise. If you have longevity in your family, that's one thing. But if you don't, and you think maybe your parents will have to end up in a nursing home or long-term care facility, that's something you want to discuss. Like, is long-term care insurance something that you need to be looking into? That can severely deplete your parents' assets in a short amount of time. Though, what is it, like $20,000 a month in some long-term care facilities? Yeah,
it's astronomical with what these prices are, and they're only getting higher, more expensive. So.
Yeah, it's incredible. So that's definitely one thing that I would look into as well.
Yeah. Perfect. Another good question.
All right, I think it's your turn to pull.
All right, here we go.
Is it? No, that was mine, right? No, that was yours. You're right.
Right.
You're right.
You're trying to take.
I was trying to take your poll.
All right. What can be done about inflation and interest rate risk?
Oof, that's a good question. Inflation and interest rate risk has been a hot topic over the last, 3-4 years, I feel like.
Yeah, I mean, interest rates, we went through a long period of time where we had really low interest rates, especially for mortgages, bonds, CDs. I mean, it was, to borrow money, it was basically didn't cost you anything.
2.5% for a mortgage.
Right.
It's essentially free money.
Right. It was almost, typically you would want to go into retirement and not have any debt. And then all of a sudden it was like, oh, if you have a mortgage, it's not the end of the world because your investments were probably outperforming that interest rate. But then we, over the last 4 or 5 years, maybe we've seen a rise in interest rates. So bonds, your fixed income started paying dividends and interest more than ever before. But we've also, on the flip side, saw higher mortgage rates. So the cost of, buying a house significantly increased. I don't know what mortgage rates are right now, but I think they're over 6%. Right?
Yeah, they're just over 6. I think the other day they were around 6.5.
Yeah. So, with rising interest rates, things to keep in mind is investment-wise that your bonds, which are typically your safety net, those are the investments that are going to be safe and maybe not as volatile as your equities or stocks. The value of those bonds are going to decrease, because no one's going to buy. Let's say you have, a 5% bond, right? And now rates are at 6%, and you want to go sell your 5% bond. Are you going to give me dollar for dollar? No, you're not going to give me. No, you would not. I mean, I can try.
I definitely wouldn't.
Yeah, okay. So you're going to have to sell it for less than, the original value. So that's something to keep in mind is, you could see on your fixed income if rates start rising, the value of your bonds decrease. Now, if you hold it to maturity, that it'll go back to the original value. But that's something to keep in mind if you're looking at your statement. 2022, great example of that. Not only did we have a down market in 2022, we had rates, skyrocket over the course of the year. And then so that saw bond prices drop significantly, where, it wasn't uncommon to see bond funds down 10% that year.
Yeah. Yeah. I'll keep this as simple as possible. One of the things that I would think about is if your inflation is, let's say it's at 3.5%, and your money sitting in cash is earning, in a savings account or a checking account or whatever, 0.0006%, you're essentially losing money by keeping it in that account because you're not keeping up with inflation. If you were to look into, there's options like a CD or a money market in some instances that are earning over 4%, you're actually keeping up with inflation and not performing inflation. That's one thing that people don't really think about is the money they're saving, they're thinking they're doing a great job by keeping it, which is fantastic. You should be building up a savings, but you want that money to work for you. So having it in a vehicle that can either keep up with inflation or outperform inflation and still keep it safe would be something to look into.
Yeah. And another investment option would be like TIPS or inflation protected bonds. So as rates are increasing, the interest rate on those bonds are increasing as well. So it's a way to kind of mitigate some of the risk of rising interest rates or interest rate sensitivity. So there are investment options out there, but keeping up with inflation is huge. I mean, same thing as keeping mattress on or money under your mattress, right?
Yeah.
It's
or in the freezer.
Yeah. It's it feels good because you're not losing, but you are losing. You just don't see it
Yeah.
until down the road. So,
Yep.
yeah, that's something to kind of keep in mind with inflation risk and interest rate risk as well.
Another good question.
Yeah.
Do we have
One more?
Do we have? Oh,
We got another one in there?
there it is. All right. With the with the stock market volatility, what can be done to help minimize risk?
All
A lot of risk questions.
I know,
today.
right? I think that's what's on everyone's mind. Well, I mean, first, it's, I think of is diversification, right?
100%.
And you can do simple diversification, stocks and bonds. You don't want to have all your investments in stocks. You don't want to have all your investment in bonds. So to kind of mitigate risk, you can have a combination of stocks and bonds. And then from there, there's a number of different things that you can kind of diversify, whether it's, U.S. equity or international. So I think diversification is probably the most important part to kind of mitigate market volatility and risk.
Yeah. Yeah, because certain areas of the market are going to perform differently at certain times. Everyone always used to talk about international kind of being the laughing stock of the portfolio or the laggard of the portfolio, if I'm going to choose a better term. It just didn't really perform all that well, but you wanted it there just in case. You wanted to diversify. And recently, international's been performing really well.
Mm-hmm.
I think last time I looked, it was close to 10%, maybe even a little bit more. So in cases like that, diversifying, making sure that you're covering your basis of different areas of the market can really benefit your portfolio, especially if you have an international exposure and then your U.S. stock exposure is doing worse like it did last month. Then you have that international exposure that's kind of keeping your portfolio afloat.
Yeah. Another thing is rebalancing your portfolio.
Mm-hmm.
Rebalancing your portfolio can help in volatile markets. Let's say, it's going to force you to buy low, sell high. So in a down market, let's say your equities have lost value. Maybe your bonds have appreciated a little bit. By rebalancing, you're going to sell those bonds at a higher price. You're going to buy the stocks at a lower price and get back to the allocation that you should be. So if you're typically a 70-30, markets are down, and now you fall into a 65-35 or 60-40, by rebalancing, you can get back to that 70-30 allocation. Markets turn around, and you can appreciate those gains a little bit faster. And on the flip side, markets are up significantly. You might be taking on too much risk. So your 70-30 portfolio might be 80-20 now. So rebalancing will help mitigate the risk by getting you back to your original allocation. So
yeah, that's one thing that people don't really think about, especially in their retirement plans, like their employer-sponsored plans, like 401ks. As you're contributing to that 401k, you're buying more and more at different times of the market. So your portfolio, even though you've allocated it a certain way, you're buying different percentages of each based off of how much you're putting in there, and can throw off the balance of your portfolio, like Matt was saying. So making sure that you check, maybe rebalance once a year, once every 2 years maybe, will help keep you on track.
Yeah, I'm trying to think if there's anything else with market volatility.
We could go into the weeds as far as market volatility and diversification. It would probably bore some people. So if you do have some more questions on it, feel free to ask, and we can certainly do that.
Right.
But it does get fairly more complicated as far as the amount of diversification you can have.
And I think with that, it's a very personal question.
For sure.
And so my recommendation would be, if you are looking to minimize risk or kind of reduce some of the volatility that you have in your account, meet with your advisor. That way they can kind of look at everything and see if there's something different you should be doing, or a rebalance, makes sense for you. The other thing some people don't think about is maybe you are typically a more conservative investor, and we've had a significant downturn in the market, and you haven't really captured all those losses because you're a little more conservative. That may be the time to take a little bit more risk. Not that you're trying to market time, but you can be a little more tactical.
Mm-hmm.
So
for sure, if the opportunity presents itself and you're comfortable with it, definitely a great time.
Yeah. Well, perfect. I think that's it for the questions. We appreciate everyone tuning in. We appreciate your questions. Keep them coming in. We'll probably try to do a few every time, and so next podcast maybe we'll have a few more, and we can do another. What is it? The finance bucket.
The financial inbox, I believe it was called.
The financial inbox. We got to work on that. I like the financial inbox though, more than the financial bucket.
Yeah.
So the financial inbox. We appreciate you tuning into the financial inbox. And that
has a nice ring to it.
Yeah, it does. Any questions or any other questions? Feel free to shoot them over, and we will see you next time.
Yeah. Thank you very much.
Thanks, guys.